So, welcome back to Doc versus IRS, episode 6. For the last 5 episodes, we watched our colleagues lose. Dr. Sherman lost his hobby loss deduction. Dr. Elbasha lost his Sudan CME trip and got hit with 20% accuracy related penalty. Dr. Olibari lost 41 months of his life. Dr. Gambhir lost her home office. Dr. Krimmelmeyer lost 3 years in prison and his license. 5 charts, 5 bad outcomes. Morbidity and mortality in every single one of them. Today, finally, we changed the script. Today, we're going to talk about a doctor who actually won. Meet Dr. Edwin R. Curphey. He's a dermatologist out of Honolulu, Hawaii. He's a W 2 employee at Kaiser Permanente, working full time clinical schedule. So in 1976, Dr. Curphey deducted a home office. He also deducted mileage between his home and his other business locations. And the IRS said, no, you're not deducting that. And he took it to the US tax court. And he won on both issues. So this case, Curphey versus Commissioner 73 TC 766, is one of the most powerful cases in tax law for hospital employed physicians. And almost no one knows about it. It's a case I wish someone had handed me at the start of my emergency medicine residency. Today, we open this chart with gloves on and walk away with a strategy. So, Dr. Curphey was 52 years old in 1976. He worked 40 hours a week as a dermatologist at Kaiser Permanente Hospital in Honolulu, and he earned $45,000 in W 2 wages from the hospital, about $250,000 in today's dollars. But here's where Dr. Curvey got smart. So, decades before Robert Kiyosaki and other financial independent movements, this dermatologist had built himself a real estate portfolio. By 1976, he owned 6 rental properties in Honolulu, including condos, townhomes, and single family home. So he managed all of them himself. This man hustle, right? He found tenants, he showed units, and he cleaned them between rentals. And he bought furnishings, he kept the books, he answered tenant calls on a code A phone answering service in his home office. That's ancient technology. So this man was running a second clinical practice, except the chief complaints were leaky faucets and broken air conditioning in Honolulu. So his goal was retirement income. So he planned to retire from medicine at 65 and live off the rental. So in 1976, those properties brought in about $25,000 in rent, but generated about $23,000 loss on paper, mostly from depreciation. Now here's a move. Dr. Curphey lived in a 2-bedroom condo. One bedroom was his home, the other bedroom was 100% dedicated to his rental business. So he has desk, bookcase, like filing cabinets, calculator, and answering machine. And the closet stored like signs and lamps and carpets and cleaning supplies in a toolbox for the rentals. And importantly, no TV, no couch, no bed. Guests didn't sleep there. Essentially sterile field, nothing contaminated in the OR for the home office purposes. And he deducted $550 for the home office and $147 for mileage between his home and the rental properties. And the IRS denied both deductions. This is where it gets good. So the IRS came at Dr. Curphey with 2 arguments. So listen carefully, because If you ever try this strategy, the IRS will make this exact same arguments to you. Same differential every time. So, argument number one, your rental activity isn't a real business. And the IRS said managing rental properties is a Section 212 income producing activity, not a 162 trader business. And Section 280A, the Home Office statute, only allows deduction for actual trades or businesses, not for passive investment management. This is what they try to do to Dr. Curphey. And it's what they still try to do today to physicians who own rentals properties on the side. So, argument number two, even if it's a business, your principal place of business is the hospital. And the IRS said, you're a dermatologist. Your principal place of business is a Kaiser Permanente, period. And you can't have two principal places of business. Just because you also manage rental does not mean your home office qualifies. This is the same argument that IRS used against Dr. Gambhir in episode 4, and they won. Remember? Her hospital was her principal place of business, so her home office failed. So, how did Dr. Curphey win when Dr. Gambhir lost? The same chief complaint, different presentation, and different outcome. Strap in. This is a lesson. Okay. The tax court ruled that Dr. Curphey's rental activities did constitute a trade of business under Section 162, and the court relied on a long line of cases like Vegan, Elect, Noble, Hazard, and others, showing that where the rental activity is sufficiently regular and substantial, the rental of real property for income can rise to Section 162 trade or business. Based on the specific facts and circumstances, even a single piece of rental property properly managed can rise to the level of a trade or business. Decades of case law. This is sort of settled medicine. But this is critical. The court also said that this is not automatic. Just owning rental property does not make it a business. And the court said the analysis depends on the scope of ownership and management activities. So Dr. Curphey's activities were he personally managed all 6 properties, and he found new tenants himself. He supplied furnishings. He cleaned and prepared units for new tenants. He kept all the books. He had a dedicated phone line for tenant calls. The court called these activities sufficiently systematic and continuous to constitute a real estate rental business. And here's your first strategic lesson. To qualify rental real estate as a Section 162 trade or business, you generally need a systematic, continuous, operational, and management activity, whether performed by you or by agents under your direction. So the pure investor who only cashes check typically won't qualify. The IRS wants to see your fingerprints on the work, such as like showing the units, screening tenants, doing the bugs, coordinating repairs, real management activities. And you don't get to round on a patient once a quarter and call it a practice, right? So this is a line between investor and business owner in the eyes of the IRS. And it matters for much more than just home office deduction. It affects passive activity rules, real estate professional status, and qualified business income deduction under Section 199A. We'll come back to this in future episodes. So now to the bigger win. The court rejected the IRS. You can only have one principal place of business argument. The IRS wanted to apply the tax home rule, the same concept used in travel expense cases. Under that rule, you can only have one tax home. So IRS said the same logic should apply to home offices. The tax court said no. And the language is beautiful. And quote, principal place of business as a term is employed in section 180A C1A refers to the home as a specific situs in which a business is carried on. We find no indication either in the statute or legislative history that a taxpayer cannot have more than one principal place of business for the purposes of Section 280A C1 if he engages in more than one trade or business. So, translation, if you have two trades or businesses, you can have two principal places of business, but each one analyzed separately. Two charts, two patients. You don't write everything under one MRN. So for Dr. Curphey, his dermatology practice had its principal place of business at Kaiser Permanente. His rental real estate business had his principal place of business at his home office. Each business gets its own 280A home office analysis. The hospital does not absorb the rental business. They're separate trades, separate analyses, separate deductions. This is the strategy. This is exactly what Dr. Gambhir didn't have. She only had one trade, her hospital W2. So when the hospital qualified as a fixed location for that trade, her home office had no other business to anchor to. So door 3 closed. Dr. Curphey had two trades. The hospital was a principal place of one. His home office was the principal place of the other. Different doors, different analyses. This one is deductible. So court also let Dr. Curphey deduct mileage from his home to his rental properties. Remember from episode 2 and 4, commuting from your home to your regular workplace is almost never deductible, except certain temporary job situations. Dr. El-Basha lost, Dr. Gambhir lost, but Dr. Curphey won, and here's why. Once the court ruled his home office was principal place of business for his rental activities, every trip from his home office to a rental property became travel between two business locations, not commuting, not personal. Business to business travel, which is fully deductible under Section 162. And the court said local transportation expenses incur in travel between one business location and another are deductible. This is a cascade running in reverse. In Dr. Gambhir, one bad ruling on the home office took her commute deductions down with it. In Curphey, one good ruling on the home office unlocked mileage deduction too. One win becomes two wins. So let me bring this home. Here's an actionable strategy that comes out of Curphey and how every physician and dentist listening can use it. This is your treatment plan. Treatment plan number 1, have a real second business, not a hobby, not a vague side hustle, a genuine Section 160 trade or business. Most common one for physicians are like real estate rental, like Dr. Curphey, like telemedicine practice, like consulting business, like med legal expert witness work, and continuing education courses that you create and sell, and a separate Schedule C clinical practice on your off days. Number 2, actively manage it. Casual ownership won't cut it. The court wants to see systematic, continuous activity. So, time logs and bank accounts, documentation of deductions, real fingerprints on the work. Number 3, dedicated space exclusively to that business. The Section 280A exclusive use standard is brutal. No personal use mixed in. No kids' homework on the desk. No exercise bike in the corner. The room must be 100% business or Section 280A disqualifies you. You want sterile field, no cross contamination. Number 4, make sure that home office is principal place of that business, not your hospital practice. That's separate analysis. So home office only needs to be principal for the side business. So if you build this structure correctly, you don't just unlock the home office deduction. You also unlock the mileage from your home to your business locations. You unlock the portion of utilities, internet, depreciation, and repair. And you potentially unlock piece of strategy stacking too, like accountable plan reimbursement and augmented retirement plans, even some 199A qualified business income deduction. One good intervention, multiple downstream benefits. This is the framework. Curphey is a precedent, and it has been for the law for over 40 years. Here are 3 discharge instructions for you. Number 1, you can have more than one trade or business, and each one gets its own 280A home office analysis. Your hospital W-2 doesn't poison every other business activity you own, whether it's real estate, consulting, telemedicine. Each one is analyzed independently for the home office deduction. Number 2, to qualify rental real estate as a 162 trade or business, you would need active hands-on management, although you don't have to fix the broken toilet yourself. The court wants to see systematic and continuous activity. That's the key. And the investor who just cashes check, which is very common in pure triple net leases, usually won't qualify. And the operator who manages does. That's number 3. A legitimate home office unlocks more than just home office deduction. It also converts your local mileage from your non-deductible commuting into deductible business travel, provided the travel trips are between business location. One good ruling cascades into multiple deductions. And here's my final thought, guys. For 5 episodes, we watched physician and dentist lose to the IRS through sloppy bookkeeping, aggressive deductions, sham trusts, wrong form, and outright fraud. We watched them lose money, lose licenses, and lose their freedom. Dr. Curphey is an antidote. He wasn't aggressive. He wasn't a fraudster. He didn't try to bend the rules. He just built deliberately a second legitimate business alongside his medical practice. He's a smart guy. He documented the work. He dedicated the space. He took only the deduction the law allowed. And when the IRS came knocking, he had every receipt, every floor plan, every piece of evidence the tax court needed. Chart was bulletproof, nothing missing, nothing falsified. He didn't win because he was lucky. He won because the work was real. And that's a lesson of the entire series so far. And it's a lesson of every episode going forward. The tax code does not reward cleverness. It rewards substance. Real businesses, real activity, real documentation, and real economic purpose. You get that right, and the deductions follow. Be Dr. Curphey. Build something real. Document it like you'll have to defend it. And when the IRS shows up, because eventually they show up, be ready. So I'm out. Build a second business. Do the work. Win the case before it ever starts.